What's up, everyone? It's Karthik with MoneyVest. So let's get ready for Monday morning. A lot of people, a lot of investors, the word on the street is that we are going to experience a pretty brutal sell-off tomorrow or even on Tuesday. So a lot of trending terms related to Black Monday, Black Tuesday, recession on Twitter, on Reddit, on all over social media forums have been trending over the last 24 to 48 hours from everything that we have experienced from over the weekend here. A lot of people, a lot of investors are expecting for not a great start to the week here that's coming up. So I'm going to break down everything that's coming up in the week ahead, including economic data, earnings, as well as some really important data related to recessions in the past 170 years. So as you guys know that I love to work with spreadsheets and data, I'm in the process of compiling yet another spreadsheet that's going to take a look at bear markets and recessions over the last 100 plus years and really help us figure out how many months prior to a recession starting the markets actually bottom. So hope you all enjoyed this video and find it helpful, and definitely do subscribe to the channel. And again, share this video with other members in your family, friends, communities, Discord groups, Telegram channels, WhatsApp channels, whatever it is. Please do share this video. It really helps out the channel grow. And 26, almost 27% of you guys are not subscribing. So please make sure that you do subscribe if you are enjoying the content and, of course, find it valuable. So what was Black Monday? Let me just quickly break this down because there's been a lot of tweets. Black Monday has been trending in business and finance. It's also buy the dip has been trending in business and finance. And there's also been trending recession, almost 63,000 posts here around these terms. And that's what's creating a lot of volatility and, of course, a lot of panic environment here over the weekend, even though the markets are closed. So Black Monday or Black Tuesday, this was Banana 3 or whatever day, will never ever happen after they were trending on social media. These things happen when everyone is not prepared for it and when everyone doesn't expect it. Lots of hedges to unwind this week. So Black Monday was an event that occurred back in 1987 in October. So October 19th, 1987. During that time, both the US and Japanese markets and the world markets globally sold off quite significantly. We hit a lot of circuit breakers. So Dow Jones was down over 22% in one single day. Just imagine the Dow Jones falling about a fifth of its entire value evaporated in one single day, and the S&P 500 lost even more. It was down a little bit over 30% in just one day. Just imagine 30%, a third of the index going down in just one day. That would be absolutely catastrophic because right now the S&P 500 is valued at over $44 trillion, right? So 44 trillion, 30% of that, we're talking over $13 trillion just gone from the S&P 500 if that were to happen today. Again, of course, 1987, we're talking 30 years ago, 35 years ago, the market's value is, of course, significantly lower than what it is today. But there's, again, a lot of people are expecting, I've seen a lot of comments even in my videos that Monday, Tuesday, markets are going to tank and they're going to go down even further because of a lot of different catalysts, whether it's geopolitical events, with the potential for the tensions arising out of the Middle East even more, or whether that is a combination of the overall negative sentiment around big tech, Magnificent Seven, including what Warren Buffett reported yesterday. I covered it in another video with him selling almost 50% of his position. So there's definitely a lot of negative connotation from this weekend. A lot of catalysts keep piling on top of each other with, of course, a lot of these posts that are also trending. Now, I don't believe that there is going to be another event like the Black Monday or Black Tuesday, but I do believe that there is going to be some additional accelerated sell-off in technology or big tech, just because if you read the room, right, if you just read the overall environment and the sentiment, there seems to be a bit of a panic, right? It doesn't take a genius to understand that, the NASDAQ in a correction, the S&P is close to a correction, the overall environment is getting a bit more bearish and a bit more pessimistic, right? So it doesn't take a genius to understand that. You can pretty much read the room in the comments, in Discord channels, in Reddit, on social media, on Twitter, everywhere you can kind of see that there is overall not a great environment. But that is good. That is good because when there is actual fear, you're actually seeing fear in the market, that usually ends up being the best opportunity to deploy cash. We've got this really interesting comedic saying in our Discord, and Kevin jokes about it all the time. If you don't really feel it in your stomach that you want to, in your stomach, it just feels like you're getting sick for when you are deploying cash into the market, that's a good thing, right? That feeling is a good signal that you're doing something right. Because if you're feeling happy and if you're feeling great putting money into the market, then most likely things are going well, right? It's when things are not going so well is when you're making the hard choices, the hard decisions, is when it makes more sense and it actually going to benefit you long term. And it's really just trying to catch the tail events, the rarity of those events that we're trying to do. So Heisenberg, this kind of cracked me up a little bit because this was a very, very funny tweet. Heisenberg tweeted, and I quote, "I swear, if someone says Black Monday, I will smack you with a 6-inch Subway sandwich, the cold cut combo. P.S. Black Monday?" Question mark. So that was actually a very, very funny tweet from yesterday, from a couple days ago, and the entire comment section was also quite humorous, talking about, potentially Black Monday or Black Tuesday. And again, the markets here selling off quite aggressively, hitting circuit breakers. But I don't believe that's going to happen. I think we've got a lot of measures in place where the buyers are going to step in. So we're going to be very clear that I am not expecting a sell-off in the tunes of double digits here. But yes, I am expecting some accelerated selling pressure, just considering the overall environment and the sentiment is not that great. But that's good because that's going to create a very good buying opportunity. In fact, one of our members and I were talking earlier today, and we were discussing that I think next week is actually going to be a week where I could see myself deploying most of the cash. The majority of the cash that I have sitting right now idle, I could see myself deploying majority of it in the upcoming week, because if the selling pressure continues, that's when I'm ready to be more aggressive and dollar cost average and buy more shares. And not to say that I'm going to go all in, and not to say that next week at some point there's going to be a bottom. I'm not calling for a bottom. I don't really know where the bottom is because I don't like to predict the markets. But really the idea is the risk reward is certainly getting better. And if it continues to get even better and improve in the coming weeks, then I will be aggressive and again, dollar cost averaging a little bit more moving forward. So now this was actually quite interesting that I wanted to break down. Warren Buffett and Berkshire Hathaway now own 4% of all T-bills issued to the public, $277 billion. And Warren Buffett is now a larger holder of U.S. Treasury bills than the Federal Reserve themselves. So that is definitely quite a significant number. $277 billion of cash is what Berkshire Hathaway now has on their balance sheet, which we discussed in yesterday's video and broke it down because quarterly numbers do suggest that, Berkshire Hathaway, Warren Buffett selling off a significant portion of their Apple stake. Now, we've had a lot of discussion around it, even in our Discord and in previous videos. And yes, there is a overall consensus that there could be a million different reasons why Warren Buffett is selling his Apple stake. We understand that when you're buying a stock, you're only buying it for one reason. You believe the stock price is going to go up. But when you're selling a stock, that could be for a million different reasons. It could be tax reasons. It could be better opportunities. It could be, just reallocation or portfolio management or anything, right? It could be a lot of different reasons, not necessarily that you're bearish on the company and the stock price is going to go down. Because if that were the case, he would be completely out of that stock if you believe that Apple was, of course, completely dud. Now, that may not be the case, but at the same time, him moving away from equity over to cash and short-term treasuries is still a pretty significant signal to moving towards flight to quality, right? Flight to quality, flight to safety, whatever you want to call it, this is still a pretty big signal to get defensive, right? This is a defensive positioning, and I don't think anybody can argue that fact. I'm not saying that he may be bearish on Apple. That's not what I'm saying. But this is more of a move about getting from aggressive to more defensive in this entire positioning, right? His positioning has certainly changed to more defensive. And that only happens, right, if he knows something related to the economy, related to Apple more specifically, related to something, right? You don't make such a big move without a reason, right? There's got to be a reason for why he's doing it. It could be a better opportunity. It could be a potential opportunity that's coming our way, or it could be, again, like I said, a million different reasons for why someone sells a stock, but there is a reason, and that reason isn't just as simple as, oh, it's Warren Buffett, you know what, he just wanted to raise some cash. There's definitely a deeper meaning to why he sold at such large quantities. Now, coming over to recessions in the US, since it was trending, I figured I'd do some analysis on the recessions over in the US. So we're going back over 170 years. So going back to 1854, when we first experienced a recession for just about 1 month. And since then, I've accumulated all the different years and all the different months of a recession. And what I'm going to do is I'm going to be working on top of this spreadsheet to really figure out which of these recessions were accompanied with a bear market for the S&P 500, right? When were we actually down over 20% from all-time highs? Getting data all the way to 1800s is actually going to be quite difficult. The data that I have right now is going back as far as 1970s and even 1950s. So I can maybe go down to this number, but going beyond 1945 to prior to those 1800s, it's going to be very, very challenging. So, we may not have a full complete picture, but yes, a decent picture for the last 70 to 80 years. But the bottom line is that an average recession does last for over 16 months, just under 17 months, so a little bit over a year. And a median basis, it's just over 1 year. So 13 months on median basis is what a recession lasts over in the US. Maximum was 65 months, which was, I believe, 1873. And the minimum was 1 month back in 1854. And then, of course, the second shortest recession we experienced was during the COVID recession in 2020. Only 2 months, and we quickly recovered because the Federal Reserve lowered interest rates fairly quickly. But in my future videos, like I said, I'm going to be working on this spreadsheet now and accumulating more and more data. And we'll accompany this with S&P 500 bear markets to better figure out the S&P 500, the market itself, how does it perform before a recession, during a recession, and after a recession in a more precise manner. But I do have some data to show you with regards to that. So this right here is going to be some understanding of how stocks perform during and around a recession. So on average, stocks performed worse 1 year before a recession started than during a recession. In the 2 years following a recession, price returns were positive 82% of the time. So meaning that 2 years after a recession took place, stocks were positive 82% of the time. So that is a very, very significant win rate with a 20% average return for the market. 12 months after, so 1 year after, we've got even a higher 91% win rate. I don't know why they didn't highlight this, but 16% average return with a 91% probability that we're going to be higher after a recession, right? After a recession. 12 months before, you can see the average return is down 3% with only a 45% probability that we're going to be higher. So it's more of a coin flip. And then 6 months after, we are 82% likely that the returns are going to be positive by an average 7%. So the bottom line is that recessions are opportunities to buy, because the probability for us to see downside here prior to a recession starting is more than after, right? Prior to a recession starting, the markets are already pricing that in, because the markets are so forward looking and because they're trying to price in what's going to happen 6 months, 12 months with the economy in the future. They already price all that information in, and they give you an opportunity today. Before a recession even starts. So that's why I think it's so important to take advantage of those buying windows for those buying opportunities, dollar cost average, deploy cash, and again, take advantage of those deals where the risk reward is getting better and better before the recession actually begins. Because once it does, after the recession, the markets are going to perform much better just based on historical data here and statistics. And that's also because Federal Reserve is more susceptible to cutting interest rates and providing some quantitative easing to the overall economy. So once they start cutting rates, that inherently is going to create a quantitative easing environment and going to create some more momentum to the upsides. Cost of borrowing is going to be cheaper. Money in general is going to be cheaper. So people are going to be able to spend, save, invest. And as a result, 6 months, 12 months, 2 years after a recession, markets tend to do really well. Now, coming over to the week in front of us, we do have a lot of things to focus on. So we do have a few Fed members talking, like, for example, member Mary Daly's talking on Monday, August 5th. We do have some manufacturing numbers. We do have import-export numbers, GDP numbers coming out, few note auctions, including the 3-year note auction, as well as the 10-year note auction taking place on Wednesday, August 7th, as well as crude oil inventories, consumer credit, continuing job claims, Atlanta Fed GDP numbers. The 30-year bond auction also takes place. So 2 very important bond auctions taking place next week, as well as the oil rigs and total counts for the oil speculative net positions also coming out on Friday. So from an economic standpoint, it's a bit of a light week, more muted than compared to other weeks. But earnings are still happening. Earnings are still going on. So this right here is the entire calendar. You can access this on our MoneyVest platform. We do have companies like Caterpillar. Of course, Palantir is going to be front and center on Monday after the bell. $665 million in revenue, with just over 8 cents in earnings per share. Disney's reporting. We got Eli Lilly, we got Gilead Sciences, we got CVS, Airbnb, Fortinet, Shopify, Monster Beverages, Take-Two Interactive, Occidental, Supermicrocomputer, Realty Income Corporation, Hilton, Coca-Cola, Devon Energy, Discovery, Sodu, just to name a few, IDEX, things like that. The companies like those are reporting. Robinhood is reporting next week as well. So we do have a week that is still packed with earnings. Amgen also scheduled for Tuesday, August 6th after the bell. So earnings coming out, economic calendar is a little bit more on the lighter side, but the bottom line is that we are coming up with some very, very interesting market dynamics here. The overall structure continues to be a bit of a correction and slash a pullback for the market. So let me know your thoughts down in the comment section below, and what are you expecting from the markets in the upcoming week. I would love to know from you guys. Make sure to drop a like and subscribe to the channel. Share this video with other family, friends, traders, investors, people in your network, so that we can get more visibility, and of course we can have more people join us in our discussion about the markets. I would really appreciate that. And let me know in the comment section down below, what are you expecting? More downside, a recovery, a technical rebound? For me, I am expecting Monday, Tuesday to be a little bit more on the volatile side. Wouldn't be surprised the VIX to get up higher and the markets to accelerate a little bit to the downside. If you come take a look at the Money Vest Index, we are now at 3.4, entering that yellow zone. And again, the lower we come down to, the better that's going to be for us, because we are going to be ready to deploy some capital. But eventually, I do expect for the markets to get a bit of a technical rebound and even potentially start making some higher highs and higher lows for that recovery back up. So hope you all enjoyed this video. Join our Discord with a 16% annual discount that's available until the end of this month. So links going to be down below. We'd love to have you on board. As always, happy investing. I'll see you all in the next video.